Hello everyone, welcome back to Bharath Nivesh with Mithun. If you are new to this channel, this is a place where we talk about Indian markets, global economic events, long-term investing, short-term risks, and most importantly, how all this affects a common Indian investor. Today's video is going to be very special and also very important because we are going to talk about something that doesn't happen often, a major global trade agreement that directly impacts India, the United States, and the Indian stock market. Yes, I am talking about the India-US trade deal. You may have seen headlines like markets rally after India-US trade deal, FII buying surges, export stocks jump. But headlines don't make money, understanding does. So in this video, we will calmly and clearly break down what exactly this India-US trade deal is, why it was needed in the first place, what changed compared to earlier trade tensions, how the Indian stock market reacted, which sectors benefited and why, what this means for long-term investors, what risks still remain, and how you as an Indian investor should think about this. This is not a buy-sell recommendation video, this is a knowledge and clarity video. So sit back, maybe take notes, and let's begin. Before we talk about India and US specifically, let's first understand what a trade deal actually is. A trade deal is an agreement between two countries that decides what goods and services they will trade, how much tax or tariff will be applied, what rules exporters and importers must follow, how disputes will be resolved. Think of it like this: if two countries are friends, they make it easier and cheaper to do business with each other. If two countries have tensions, they make trade expensive and complicated. Now, tariffs are the most important part here. A tariff is simply a tax imposed on imported goods. For example, if an Indian company exports garments to the US and the US puts a 40% tariff on it, that Indian product becomes expensive in America. As a result, demand reduces, orders drop, company profits fall, stock prices suffer. This is why trade deals matter so much to markets. Now let's understand why this deal was needed at all. India and the US are strategic partners, but trade relations have not always been smooth. Over the last few years, the US accused India of protecting its domestic markets. India accused the US of unfair tariffs. Several Indian export categories were hit with high import duties. There were a few key affected sectors, which included textiles and garments, leather goods, marine exports, engineering goods, certain auto components. At one point, tariffs on some Indian goods entering the US went as high as 40 to 50%. For Indian exporters, this was very much painful. Many companies had shrinking margins, reduced US orders, higher working capital stress. For stock market investors especially, this created uncertainty, lower valuations for export-oriented companies, fear of long-term damage to Indo-US trade. This trade deal is essentially a reset button. So what exactly does the new India-US trade deal do? Let us come to the heart of the matter. What changed with this new deal? The biggest highlight is tariff and tariffs reduction. Under the new agreement, the US has significantly reduced tariffs on multiple Indian export categories. Average tariff levels have come down sharply compared to earlier. Trade uncertainty has reduced. This does not mean all tariffs are removed. Everything becomes duty-free overnight, but it does mean Indian exporters become more competitive. price pressure will reduce, profit visibility will improve. This deal sends a strong political and economic signal. India and the US wants stable and long-term economic cooperation. Market loves stability. Now let's talk about what investors love the most. The main thing is with the market reaction. The moment this trade deal news came out, Indian markets reacted positively. Sensex and Nifty opened strong. Export-heavy stocks saw buying interest. FIIs turned net buyers. Markets are always forward-looking. Investors were not reacting to today's profits, they were reacting to future earnings visibility. So, what does this mean? Revenue predictability improves, margin pressure will definitely reduce, confidence in the business improves. This is why markets often move before actual results improve. So, let's talk about FIIs or foreign institutional investors. FIIs always look for policy stability, global integration, ease of doing business, predictable trade relations. Trade tensions are a red flag for FIIs. This deal helped in reducing geopolitical trade risk. It also improved India's image as a stable export partner. It strengthened India's global economic positioning. That is why we saw increased FII participation, renewed interest in Indian equities, positive sentiment in large caps and exporters. FIIs don't fall in love with countries, they fall in love with clarity. Let me pause here and ask you something. Did you notice any export stock moving sharply? Any sector suddenly coming into news? Any stock in your portfolio reacting to this deal? Comment below and let me know. I read every genuine comment. If you're considering about the sector-wise impact, you'd be wondering who would benefit the most. So now let's move into one of the most important parts of this discussion, which sectors actually benefit from the India-US trade deal. Because not every company benefits equally, some sectors gain directly, some gain indirectly, and some may see almost no change. Let's go step by step. When it comes to textiles and apparel, first and foremost, textiles and apparel are the ones that will definitely get benefited. India is one of the largest textile exporters in the world. The United States is one of the biggest buyers of Indian garments. When tariffs are high, Indian products become expensive in the US market. Buyers shift to other countries like Vietnam or Bangladesh. But when tariffs fall, Indian exporters regain competitiveness. This leads to higher export volumes, better pricing power, improved margins, increased factory utilization. For stock markets especially, this translates into improved earnings expectations. But remember something, this is not instant magic. Export cycles take time, orders don't double overnight, but sentiment improves first, and sentiment drives stock prices in the short term. The next sector is with the leather and footwear. The sector is highly export oriented. Many Indian leather companies depend heavily on US demand. Lower tariffs mean Indian leather products become more affordable in the US. Retail chains may increase sourcing from India. Long-term contracts become more attractive. This sector is also labor intensive. So if exports grow, it helps employment, it improves manufacturing activity in India, it helps with regional economic growth, and investors tend to reward sectors that show export momentum. The next sector is with the seafood and agricultural exports. If we talk about seafood and agricultural exports, India exports a significant amount of marine products to the US. Tariff reductions here will improve price competitiveness, demand stability, export profitability. However, this sector is also sensitive to currency fluctuations, global food demand, logistics and supply chain issues. So while the trade deal helps, it is not the only factor that determines performance. The next sector is auto components and engineering goods. India has a very strong auto component manufacturing base. Many global automobile companies source parts from India. This reduced trade friction improves cross border supply chains, long term supplier relationships, manufacturing confidence. This sector benefits not just from tariffs but also from global manufacturing trends. As companies diversify supply chains away from single country dependence, India becomes more attractive. The next sector is with the specialty chemicals. This is one of the interesting sector. India has been emerging as a major player in global chemical manufacturing. Trade stability encourages long-term contracts, capacity expansion, foreign investment. Chemical companies often operate on multi-year contracts. So policy stability is extremely valuable here. The next thing is with the currency impact and the role of the Indian rupee. So let's discuss something that many retail investors ignore: currency movement. When trade relations improve and foreign investment increases, the Indian rupee can strengthen. A stronger rupee has mixed effects. For importers, a strong rupee is good. Imported goods become cheaper. For exporters, a very strong rupee can reduce competitiveness, so there is always a balance. In the context of this trade deal, moderate currency strength reflects investor confidence, but extreme currency appreciation can create new challenges. This is why central banks carefully monitor exchange rates. For investors, the key takeaway is currency stability is more important than currency direction. Stable currency reduces uncertainty, and markets reward stability. Now we must separate excitement from reality. In the short term, markets react to news quickly. Stocks may rally sharply, trading volumes increase, momentum traders enter the market, but long term performance depends only on the fundamentals. For this trade deal to create lasting impact, we need to see sustained export growth, improved corporate earnings, capacity expansion, strong order books. If companies convert opportunity into real business growth, the rally becomes sustainable. If not, markets may correct after initial excitement. This is why long term investors must focus on business quality, not just headlines. This trade deal is not just about India and the US, it reflects broader global trends. The world economy is becoming more interconnected but also more cautious. Countries want reliable trade partners, diversified supply chains, stable economic relationships. India is positioning itself as a trusted manufacturing and export hub. This deal definitely strengthens that image. It signals that India is serious about global economic integration, and global investors watch these signals very closely. Now, let me give you a practical warning. Whenever big news comes out, retail investors often make mistakes, and those common mistakes include chasing stocks after a big rally, buying purely based on headlines, ignoring company fundamentals, assuming that every company in a sector will benefit equally. Smart investing requires patience. Not every exporter is a winner, not every rally is sustainable. Always analyze debt levels, profit margins, management quality, competitive advantage. News creates opportunity, but discipline creates wealth. Now that we have discussed the opportunities, we must talk honestly about risks, because no trade deal eliminates uncertainty completely, and a mature investor always looks at both sides. The first risk is execution risk. A trade agreement on paper is one thing, actual implementation is another. Export growth depends on how quickly companies scale production, whether supply chains remain smooth, global demand conditions, logistics efficiency. If global demand weakens, even favorable tariffs cannot guarantee strong growth. The second risk is global economic slowdown. The world economy moves in cycles. If major economies slow down, consumer demand drops. When American consumers spend less, retail orders shrink, export volumes fall. This affects Indian exporters regardless of tariff advantages. So, investors must always monitor global economic signals. The third risk is geopolitical uncertainty. International trade is influenced by politics, government priorities change, and policies evolve. While this deal improves relations, future negotiations or disputes can still arise. Markets constantly price geopolitical stability. That is why diversification remains essential. Now let's talk about something deeper: investor psychology. Markets are driven as much by emotions as by numbers. When positive news arrives, optimism spreads quickly, fear or missing out increases, people rush to invest, but experienced investors understand something important. Markets often overreact in the short term. Prices can move ahead of fundamentals. That is why discipline matters. Instead of chasing momentum, smart investors ask: is this company fundamentally strong? Is valuation reasonable? Does it have sustainable competitive advantage? News should guide research, not replace it. Another psychological factor is narrative investing. When a strong story emerges, markets build a narrative around it. For example, export boom is coming, India will dominate global manufacturing. Some narratives eventually prove correct, others fade over time. Your job as a long term investor is not to blindly believe narratives. Your job is to evaluate evidence. Now let's step back and look at the bigger picture. This trade deal fits into India's broader economic journey. India is gradually positioning itself as a manufacturing hub, a global export player, a stable investment destination. Several long term factors support this vision: a young workforce, expanding infrastructure, digital transformation, policy reforms. Trade agreements like this accelerate integration with global markets, but sustainable growth requires consistent policy execution, industrial competitiveness, innovation, and productivity. For investors, the key message is this: India's long term growth story remains intact, but progress is gradual, not instantaneous. Wealth creation happens through patience. Now let's talk about strategy, not stock tips but strategy. When a major macro event like this occurs, investors should think in layers. First layer: awareness, understanding what is happening globally. Next layer is with the sector impact. One should identify which industries are structurally positioned to benefit. The third layer is company quality. One should always focus on businesses with strong balance sheets, efficient operations, capable management, sustainable competitive advantages. When it comes to fourth layer, it's all about valuation discipline. Even great companies can become poor investments if bought at excessive prices. Strategic investing is about balance. Opportunity plus discipline equals sustainable returns. Let me address a few questions investors often ask in situations like this. The first question will be: should I invest immediately after such news? Not blindly. Use news as a starting point for research, not a trigger for impulsive action. Will this trade deal guarantee a long bull market? No single event guarantees market direction. Markets respond to a combination of factors. Is export investing a safer option now? It may have improved prospects, but risk never disappears. Diversification is always a crucial and remains essential. So let's summarize everything we discussed today. The India-US trade deal reduces tariff pressure and improves trade stability. Export-oriented sectors may benefit from improved competitiveness. Markets reacted positively because investors anticipate future earnings growth. However, risks remain: global slowdowns, execution challenges, geopolitical uncertainties. Long-term investors should focus on fundamentals, discipline, and strategic thinking. This event is an opportunity, not a guarantee. And successful investing is about converting opportunity into informed action. And thank you very much for spending this time with me on Bharath Nivesh with Mithun. If you found this deep dive helpful, Please do like the video, share it with fellow investors, subscribe to the channel, and turn on notifications because on this channel we don't chase hype, we build understanding, and understanding builds wealth. Until next time, stay informed, stay disciplined, and happy investing. Thank you for watching and you have a great day. Bye bye.